Hi, welcome. In this session, we will discuss how stock prices are determined. So, in the previous session, one of the previous session, we have defined equity market where claims on the net income, the holder of equities has the claims on the net income and assets of the business. So, there we also discussed that there are two markets, one is primary markets where new issue of a security or new issue of a share happens, and then about the secondary markets where transaction of an already issued security happens, where brokers and dealers are there. And in today's session we will focus in the secondary market, that is called the stock markets, and there how stock prices are determined and what are the other factors. For example, the interest rate which we discussed in the in the previous sessions, and some monetary policy, how does it affect the stock prices. So, in this slide I have taken some screenshots of some leading stock exchanges. So, where you can see the first one, Dow Jones Industrial Average. So, you can see this is the index. This actually computed by looking at the stock prices of 30 large companies listed on stock exchange in the US. So, you can see the S&P 500. This also developed using the stock performance of 500 large companies listed on stock exchanges in the US. So, Nasdaq also you can see is a composite index, is actually include over the stock prices of 2500 companies listed in the Nasdaq. So, this actually built, you can see that it has been built based on the stock prices, and the index it has been built, and over time it has been followed. So, when it comes to Indian context, I think you are familiar that we have two major stock exchanges. One is S&P, that is Bombay Stock Exchange. You can see this is the stock, this is the index. Here Nifty also is given. In the case of BSE, S&P BSE, you can see that is a free float market weighted stock market index of 30 well established and financially sound companies. And there are different types of indices. For example, top 100 companies, this is another index. So, whichever you want, accordingly you can follow. Similarly, you can see Nifty 50 index is based on the 50 top performing listed companies. This index has been built. So, I am also giving the screenshot of major stock exchanges in the world, starting from New York Stock Exchange, Nasdaq, etc. This is just for your information. So, what is happening in the stock exchange? I am sure you are familiar. That means the transaction of already existing stocks. Then the question comes, how do we calculate the price of a common stock? So, what we can observe that in the market, already we observe what is the current price of a stock, but for our analysis purpose, how do we, given certain information about a company stock or company, then how do we calculate the price of a stock? Before doing that, let us make a quick review of bond pricing. So, here what is the price, for example, let us start with the basic which we have done in one of the previous class. What is the price of a 1 year 8% coupon bond? For this, you know that we need the following information: what is the face value, what is the coupon rate, and what is the interest rate. So, suppose the interest rate is 5%, suppose we have this information, face value we have, coupon, that both we already know, and the interest rate is for example 5%. Then using this formula which we have used in the previous class, we know that the price of this bond with a face value given the coupon rate of 4 and 5%, we are going to get the current bond price is going to be 51.43. So, then let us think about the stock price. So, what is your willingness to pay for a stock with the following features? That means instead of coupon, let us put that the expected dividend the stock is going to give you in the next year is going to be $4, and expected price next year is going to be, the price of stock in the next year is going to be $50. So, in this scenario, what is your willingness to pay for a stock with the following these features? So it's not that easy to calculate, because both look like similar, but one big difference. The big difference is that next year dividend, for example, the next year dividend which I said here is $4, and next year price, both are in fact expectations. The realized price might be different, right? So buying the stock involves some risk. In this scenario, we think that computing the price of common stock, we need to look into some values, that actually what is going to be the next year dividend, the expectation we need to compute, what is going to be the next year price, plus we also need to see what is the discount factor. For example, in the case of bond we have interest rate, but here in the case of stocks we do not have any interest rate. So we need to find out some value that can be used as a discount. So in order to compute the price of common stock, one of the widely used method is the one period valuation model. It shows that the price of stock at present, current, that means P naught means current, the current stock price is going to be dividend that you are going to get in the next year, plus the price of stocks in the next year discounted by 1 plus KE. So what is this KE? So let us point out that the P naught that I already mentioned, current price of the stock, the present discounted value of the expected cash flow. That is the current price of the stock, the present discounted value of the expected cash flows, and D1 dividend paid at the end of next year. KE, the required return on investment in equity. This is actually determined by so many other factors. What is your return on alternative investment? For example, investment in a bond. Suppose you are getting 10% as the interest income, 10% interest from investing in a bond. That actually going to influence your KE, required return on investment in this equity. Obviously you need to get more than that, right? Because this investment in equity involves some more risk than as compared to the investment in a bond. So this is the required return on investment in equity. So the expected return on shareholders equity is equal to risk free interest rate, for example 10%, which I mentioned here just now, plus you need some risk premium. For example, because you are going investing in stocks, there are volatility and uncertainties there. You don't know what is going to happen after 1 year, when after in the future maybe the company may collapse. So all the possibilities are there. So in order to incentivize you, you need a risk premium. Maybe for example you need 5% as a risk premium. So that is how this value of this KE is determined. So in this case KE, we can also say that this is a kind of discount rate in this context. This is going to be a discount rate also, we can say. So P1, which we already mentioned, the expected sale price of the stock at the end of the first period. Then now let's see, illustrate using an example what is the price of a stock. So using this one period valuation model, suppose you have been given this information, that means the expected dividend next year is going to be $4, and expected price next year is going to be $50, and assume that, just for the sake of simplicity, let us assume that your KE is going to be 10%. Maybe we can build it like that, 8% is the current interest rate and 2% is the risk premium. So let us make it, assume KE is going to be 10%. So plugging these values in the formula that we got here, we can calculate the price of the stock. So we are going to get, with given these features, that is the dividend and D1 and P1 with the KE of 10%, that is 0.110 10%, then plugging this value, we can see that the price of this stock in this market, given for an individual who is willing to pay, who is having this KE expected value, the required return on investment in equity, given these informations, is going to be 49.09. This is one period valuation model. But you know that stocks is not just for a 1 year investment. So this is till its lifetime. is a long term investment. That means you are getting the share of a company, right? As long as the company exists, you are the shareholder of that company, as long as you are not selling. Suppose you are, in case you are not selling this share at all, so that means your ownership in that company is for a long term, so actually infinite time period. So your current stock price, it should reflect not only just next year dividend and stock price, expected price, but actually for the infinite forecasting horizon we need to include. So in this case, we are going to develop this formula, expand this formula. This formula has two components now. The first component is the present value of future cash flow from dividend. That means dividend in year 1, year 2, plus you can see dividend for nth number of years. So here we need to discount it with the value of KE, this one. So same, that KE, that is the present value of all future cash flow from the dividend, plus we also need to calculate the present value of future present value of the price of stock in nth year. So this is the formula that we are going to get. But one of the issue here is that if PN is far in the future, obviously it is going to be far in the future, because we already say that the share means is a long term investment in the share of the company. That means not just for 1 or 2, 3 years, so is a number of years. So in this case we are going to see that when the PN is far in the future, it won't affect P0 at all. How come? So let us see this. For example, the present value of a share of stock that sells, for example, for 75 years from now. For example, let us take it for sake of simplicity. We are just taking 75 years is the time period for the stock. Actually should be more than that. So suppose assume that this is 75 years. So a stock that is selling today with 75 years from now, using a 12% discount rate, that the KE. So in this case, what you can see that if you calculate here, if plug value here, you are going to get the present value of this stock is going to be $0.01. That means it's less than 1 cent, right? 1 cent only. Suppose if you increase it to 100, that the year, this one when you go to increase it to 100, 200, 500 years, something like that, if you are going to do, then obviously you know that this value is going to be 0.0000, right? Something like that is going to be like that if you increase the number of times per horizon, the forecasting horizon, if you increase. So from this, what we can see that in the calculation of the current price of stock, the current price of the value of the stock today is going to exclude this part, is going to include mainly the first component, that is the dividend stream, that is going to the cash flow, present value of the cash flow from the dividend alone. So accordingly, it implies that the current value of a share of stock can be calculated as simply the present value of the future dividend stream alone. So accordingly, we can redefine this formula in this way, that is the T, that means infinite time period, only looking at the dividend aspects, only the dividend from the stocks. So to summarize this point, the price of the stock is determined only by the present value of future dividend stream. Okay, so we agreed that this is going to be the formula for computing the stock price, only looking at the future dividend stream. Again we are getting here the n number of year, the infinite time period that we are getting here. This also practically difficult. Maybe we can forecast the dividend for year 1, 2, 3, 4 maybe, but beyond that it's practically difficult to know what is going to be the dividend a company is going to give in the 3rd year, 4th year, 5th year, like that, right? It's practically difficult because we can only see when we see that what is the actual dividend or that the company is giving. And in order to address this, you know that most companies, because they also don't want to, suppose the company is doing well, suppose the next year the company is doing well, and what they do that actually they are earning lots of profit and they are having lots of, they can distribute lots of dividend, but sometime the company may do bad in the year after next. So in that case, if they see that there is going to be some fluctuation in their business, so normally what companies do that they don't distribute all their profits in the form of dividend. Some dividend they keep it as undistributed profit that will be used for the financing the operating cost of the company. That will contribute to the internal finance of the company, and also to compensate if there is decline in profit in the future. In order to compensate the dividend, in order to ensure that the shareholders get a fixed amount or a certain amount of dividend, most companies they do that, they normalize their dividend distribution in order to compensate if there is some up down in their profit. So in that case, we can forecast that companies, we assume that companies sometimes follow a try to give a constant amount of the dividend at a constant rate. So we can see that by using this one, that means a constant dividends. Suppose company is going to give 3% this year, next year also they try to stick to 3%, 3% next year, year 2 after, like that. If the company is really doing well, then obviously you can say they are going to increase to 4%, but they will try to stick to that amount. But they won't try to give in 1 year they are going to give 4%, another year 20%, and next year again 3%. That not a good business model. So looking at this idea that the practical aspect, that means most companies they try to give a constant dividend at a constant rate. One more model that is recommended for calculating the stock price is the Gordon growth model. So this is a generalized dividend valuation model that requires that we compute the present value of an infinite stream of dividend, a process that could be difficult. Thus a simplified model have been developed to make calculation easier. So this assume the simple model, that is Gordon growth model, it assume a constant dividend growth. So as I already mentioned, many firms try to increase their dividends at a constant rate each year. So accordingly, we can see that this is the growth rate, dividend growth rate. We can see here that. So this is the formula accordingly. If you state this one, this is the dividend that the company given in the most recently, maybe you can say that today or yesterday or tomorrow, yesterday or today, that means most recent dividend. G is the expected constant growth rate in dividend. KE is the, which we already discussed, the required return on an investment and in equity. Accordingly, the Gordon growth formula is like this. That means price of stock, the present price, the price of stock is going to be D naught times 1 plus G divided by KE minus G. So the G is the growth rate, the expected constant growth rate in dividends. So rewriting this formula, we can get a very simplified formula that the current price of the stock is going to be D1, that is the stock price dividend paid at the end of year 1, dividend to be paid at the end of year 1 divided by KE minus G. So these are the explanation for that. So this is the formal derivation for this formula. Then to get how we are getting P naught is equal to D1 by KE minus G. So now let's see, based on this Gordon formula, how the market sets stock prices. How do we apply this Gordon formula in understanding how market sets stock prices? Importantly, the stock market, this is one of the place where demand and supply, but the market actually truly the demand and supply really plays its role. So price is set by the buyer willing to pay the highest price. Given that demand and supply, then the price is set by the buyer willing to pay the highest price for that stock. So market price will be set by the buyer who can take advantage of the asset. Superior information about an asset can increase its value by reducing perceived risk. So because we have already seen that stock price, it actually reflects even the your required rate of return, that the KE, that include not only the return from alternative investment plus you also need a risk premium. So, superior information about an asset can increase its value by reducing perceived risk. So, information is important for individuals to value each assets. So, the value of your KE is subject to the information that you are availing, that you are having about a company. When new information is released about a firm, whether this firm is going to do well, or the financial condition of the firm or the business condition of the firm is bad, then obviously you know that all these going to affect expectation and the prices of the stock. So, accordingly expectation and prices of the stock are going to change. So, market participants they constantly receive information and revise their expectations. So, stock prices change very frequently. So, now let us apply, given this information, let us apply the Gordon formula to calculate what will be the maximum willingness to pay for a particular stock by 3 individual buyers. Suppose the information common to all the 3 individuals are the expected dividend next year is going to be $2 and expected growth in dividend is going to be 3%, that is 0.03. So, in this case what are the information we need, because we have the dividend D1 we have, G we have, and we also need information on KE, right? We need information on KE, but KE varies from individual to individual because this is based on their perception about the market and the amount that they are required for them in order to make an investment, which we have already seen. The expected return, KE is actually includes the expected return, the return that they are going to get from alternative investment plus the risk premium. This actually varies from individual to individual. So, let us assume that there are these 3 individuals with a varying level of uncertainty about D1 and G, about their information, because these are all expected, right? Both are expected. So, the uncertainty about the D1 and G, suppose individual A, he is very highly uncertain about this D1 and G. He expects that company may not give these 2 and think that 2 dividend is not going to give, and the growth rate also he expects that it may be even less than that. So, in this case assume that the KE of this individual A is going to be 15%, and for the individual B his uncertainty level is little bit lower than individual A and he needs only 12%, and individual C he is less uncertain, he is confident that this is going to be what these values are going to be same. That means this, you know, that the dividend and the expected growth rate is actually a function of the general business condition, that the macroeconomic risk plus the systemic and some of the firm specific risk as well. So, this individual suppose he is less uncertain, he needs a KE of 10%. So, accordingly if you plug these values into this formula we know that we are going to get 3 different prices, or the willingness to pay for, or the P node, we are going to get 3 different values for all these 3 different individuals. So, we can see here that what are their willingness to pay for the stock. So, if you calculate this one, you can see that the individual A, his willingness to pay, he priced these stocks at $16.67, individual B is going to give price at 22.2, and individual 3 his willingness to pay is going to be his valuation, his P note for individual C is going to be 28.57. So, from this obviously you know that whose K is low. For example, here individual C, his K is low, he is less uncertain. So, he is willing to pay high price for this stock, that is going to be $28.57. So, from this example you can see that for suppose in this market there are only these 3 individuals and they don't know each other, and some individual who is holding this stock is willing to sell it. He deliberately looking for selling it. So he is actually, what he will be doing, that he is desperate. The individual who is holding this stock, suppose he is desperate that he wants to sell this stock, then in this case you know that these three individual A, B, C, they don't know each other what is their willingness to pay. So individual A, he is willing to pay maximum this much, and individual B, his willingness to pay maximum this much, and individual C, his willingness to pay is 28.57, that is his maximum willingness to pay. So in this case, what is going to be the stock price? So obviously the supplier of stock, the seller of the stock, want to get the maximum. So this won't be the stock price, because this individual A, he is willing to pay 22. So this individual A is out of the market. Then when individual B, his willingness to pay is maximum 22.22, but individual C is willing to pay 28.57. So assume that there are only three individuals here. You know that anyway they are not sharing each other's willingness to pay, but this person, he is willing to pay 28, but since the second person, he is going to pay maximum this much, so the stock price is going to be a little bit above this one. That means, for example, 22.23, or maybe we can make it as a round figure, or maybe we can just make it to 22.50, suppose, but it will be, going to be, the price is going to be 22.23, right? So because here he is willing to pay maximum this one, so then another, there is only another individual, he, so he actually willing to pay maximum this one. In between some other individuals comes, then obviously the stock price will increase. But here, since his willingness to pay is this much, and but second B is this 22.22, so his actually the stock will be sold at a little bit above the stock price of 22.22. Applying this formula, suppose so most often you see that sometime central bank, the governor of RBI or any policy makers, they say that sometimes they make an announcement that when the stock prices are low in the market, when overall the economy is really doing bad, so they sometimes say that they are going to increase the stock price through reducing the rate of interest. And how we can explain this one using the Gordon formula. And let us take our Gordon formula here. Suppose when RBI lowers interest rate, what is going to happen here? The return on bonds, that means alternative asset to stocks, declines. Then the investors are willing to accept a lower KE. That means the KE in this case, he is going to accept a low value. So that means if you reduce, suppose this KE value, when you keep on reducing, obviously you know that the value of PE is going to increase. This is one mechanism, one pathway. And another thing is that when policymakers, when RBI reduce the interest rate, obviously you know that when the interest rate is reduced, the cost of borrowing for the firms reduces. That means the cost of production reduces, then they increase production, then it will lead to higher GDP, and the growth rate in the economy also increase. That means the dividend of the company also increase, because the cost of borrowing reduces, declines, that means the profit also increase. So this actually means the G increases. When the G increases, you can see that again the stock price is going to increase. So when you can see, when the KE, when this expectation, this value KE reduces, then stock price increases. Similarly, when G increases, then the stock price increases. So this is the pathway to explain how monetary policy expansion increase the stock prices. Similarly, we can also see that the same formula we can apply during the global financial crisis. You know that during crisis, you know that the G rate, it declines, the growth rate declined, and you also know that when during financial crisis, it also led to the economic crisis as well. Then you know that there is high increased level of uncertainty in the economy, so you need the increase in required return, this also increases. So because of both, that the G is declining, KE is increasing, because of both, you know that the stock price is going to decline as per the Gordon formula. Thank you.